Are you struggling with prop firms? Hey guys, my name is Don Aslam and welcome back to my channel. If you haven't already, like and subscribe. And today we're going to be speaking about Forex indicators for beginners, an introduction to technical indicators used for Forex trading and analysis. So we're going to be going through just breaking down what indicators are, how they can be used, and my personal intake on them. So introduction to Forex indicators. So basically, what are they? I'll just read this out. Forex indicators are mathematical calculations used on a currency pair's price chart to forecast future price movements. They help traders analyze the market and make trading decisions. Common types of indicators include trend, momentum, volatility, and volume indicators. When added to a chart, they provide visual signals for entry and exit points. Using indicators along with technical analysis can improve trading accuracy. So they basically just give you they're not really signal providers when to enter and when to exit. You've got to use them alongside other confluences, and then you take the trade. But obviously, like I mentioned, I'll give my own personal take on this near the end. But for now, we're just breaking down exactly what they are. Keeping it nice and simple for those who don't know what they are, and just taking it one step at a time. So obviously, types of Forex indicators: there's trend indicators, momentum indicators, volatility indicators, volume indicators. So trend indicators, guys, basically simply measure the direction and the strength of the overall market. Example, moving averages, MACD. These are also indicators. Momentum indicators identify overbought and oversold market conditions and potential trend reversals. Example, RSI, stochastics. Volatility indicators measure the size and magnitude of price fluctuations. Example, Bollinger bands, average true range. And volume indicators, gauge market activity and investor participation using trading volumes. Example, unbalanced volume and the check-in money flow. So using a combination of different types of indicators can help traders gain a more complete market perspective. They all have their edge, they all have their downside. It's just basically what will suit your personality and what your trading strategy. So example, we've got the first example here, moving averages. We've got a picture of the candlesticks on the right of the charts, and a moving average is an indicator that shows the average price of a security over a specific time period. Moving averages smooth out price fluctuations and help traders identify trends and momentum. The most common moving averages are the simple moving average, the SMA, and the exponential moving average, EMA. And SMA sums up the prices for the period and divides by the number of time periods. And EMA applies more weight to recent prices. Using moving averages together, such as a 50-day and 200-day, can generate trading signals when the averages cross. So on the right side, in the green line, we've got the 200-day average, moving average. The 50-day is the black line, and 100 for the red line. And as you can see, when they cross, normally traders look at this as a signal that there's going to be a market shift. And first the market was going a bit bullish, but then it just with a little bit obviously making lower highs, then it just tanks and market drops. Now obviously, don't just go over these where as soon as the lines cross and you just take a sell or a buy. It doesn't work like that. You've got to look at other confluences. Most traders, the good traders, use normally confluences about minimum 3 to 5. The more confluences, the better, the stronger the setup. So don't just use indicators alone, guys. They're not signals where they're just going to make you always be 100% correct. So there's other confluences that factor into this. Now, Bollinger bands is a technical indicator created by John Bollinger in the 1980s that uses a moving average and standard deviation to plot trading bands above and below the prices on a stock chart, as shown in the example on the right. When the bands tighten, it often indicates decreasing volatility and potential reversal points, while widening bands and indicate increasing volatility and strength in the current trend direction. Now obviously on the right side we can see that, you know, it's a picture that I've taken from one of my charts. I don't use any indicators, but just for example's sake, I've taken a picture for you guys just to get a better visual. You know, as you can see, the one of the moving averages, well, there's two moving average lines in blue, and the middle one is the orange. So the idea behind this indicator is, in simpler ways to put it, is once price touches, example, the top blue line, the moving average, you take a sell, because maybe the price is about to, you know, just start touching the moving average and then bouncing in the opposite direction. And then as you can see, once this example here, price moves up, touches the blue line, comes back down, touches the next blue line and starts moving up. Now obviously, as you can probably see, is, you know, the hard part for beginners probably, where do we exactly enter from? You know, it's not exactly that clear, you know, and that is obviously one of the downsides. But yeah, that's just an example of what a Bollinger Bands are, and we look at other examples as we go along. The MACD, the moving average convergence divergence indicator. MACD indicator is a technical analysis tool that traders use to identify changes in momentum and trend direction. It involves two moving averages, a faster EMA and a slower EMA, and the difference between the two lines plots the MACD. Crossovers over the MACD line and signal line can generate trading signals. The MACD is a lagging indicator but can be useful for spotting divergences and overbought oversold conditions. Now obviously I have used this indicator like I mentioned earlier, but only for like maximum 2 days. I personally did not, you know, like it, so I stopped using it a long time ago. But again, the idea behind this is obviously gives you indicate like signals when the price might be oversold or overbought. But I mean, again, you need confluences. The more you have, the better. Don't just use this. You can use trend lines. You can use, you know, other indicators with this. So you can just, you know, price action, candlestick patterns, and all that. Other factors go into it. Don't just, you know, go off this indicator alone. The next one is the RSI, the relative strength index. RSI is a momentum oscillator that measures the speed and change of price movements. RSI oscillates between 0 and 100. Readings above 70 indicate overbought conditions, and the readings below 30 indicate oversold conditions. So basically, the idea behind this indicator is, as the example on the left, as you can see, is once price, you know, if it's, you know, the line goes and touches the oversold 30% area, you take a buy. Once it goes, you know, near the 70%, but in the picture, but you can't see the 70%, but and then you take a sell from there. Now obviously that's not the best way to trade this indicator, just solely on the basis of that. Other factors again with the confluences go into it. But yeah, this is one of the indicators I did use quite a bit in the beginning, but as again, I just thought it was a lagging indicator. I mean, the reason I don't use any indicators, guys, is just because they're lagging. So you will always, you know, they will drop a signal, but by then price already moved in simply. So now, okay, now the next is the Ichimoku cloud indicator. I don't know if I pronounced that right, but it's developed by Goichi Hosodo, and it's composed of 5 lines that represent different price levels and trends. The key components are the Tenkan Sen, Kijun Sen, Senku Span, and Senku Span B, and the Chiku Span. Together these lines create the Kumo or cloud, which indicates support and resistance levels and the overall trend. Now that was a mouthful reading that paragraph out, but the idea behind this indicator is obviously it will, you know, give you a better idea on support and resistance levels, you know, the amount of times where price has reached a high or a, you know, low, and numerous times the retesting price, and maybe there's a price reversal opportunity. So that's the idea behind this. I used this indicator, I believe it was about twice. After that, you know, I didn't really get a feel for it, so so I stopped using it after that, and just sticking to naked price action, meaning just keeping my charts clean as possible. Okay, so another one is the unbalanced volume indicator. This is a technical trading momentum indicator that uses volume flow to predict changes in stock price. OBV is calculated by taking the total volume for a period and assigning it to a positive or negative value depending on whether the closing price for that period is up or down. So I mean if you can see on this side, you can see the trend lines. That'll be better for you guys. So I mean, you can see the trend line. As soon as price touches that line, it bounces, in the opposite direction. This doesn't always happen. I wouldn't always just go on this. You can see just volume coming to an end, and then momentum just dying off, and then boom, shot in the buyers kick in, and the price just push the price up. I would use other confluences as well. I can see they're using a trend line. That's maybe a second confluence. There are other obviously confluences that can be used as well, so I wouldn't just solely go on this indicator alone. Okay, the key takeaways. Number one, Forex indicators help trade analyze the market. Indicators provide additional data points and signals to help traders make informed trading decisions on the charts. Number two, there are four main types of Forex indicators. The main indicator types are trend, momentum, volume, and volatility indicators. Number three, use indicators to confirm your analysis. Indicators should complement your existing trading strategy and analysis. Don't rely solely on indicators like I mentioned earlier. So Forex indicators are useful trading tools when used properly in conjunction with a solid trading plan. So I mean, me personally, I don't use any indicators. I have pulled out obviously for examples. Okay, so this obviously is the MACD. Now I don't use this because it's a lagging indicator. I only use one indicator, guys, and it's this one here. That's it. Why? Because it just shows me, example, the blue is the London session, London Open, it tells me that. Red, Asian session. Yellow, New York session. Nothing tells me when to buy, not when to sell. I use my own technical analysis. Look at the chart. Like, even if I remove this, basically this is what I look at. Sometimes I do remove the indicator as well, and I just look at naked price, just go off this. I don't use indicators. So just one moment, let's just bring one indicator into this. So I do have them as favorites from the past, but I've still not removed them. But okay, let's go off this. Okay, the Bollinger Band indicator, this is why I don't use it. So as the example mentioned, when price moves up, touches the top line, it's supposed to start selling off. Okay, so it does do that. But now if I was to, so just one moment. Okay, first the first touch was over here, but as soon as it touches the top blue line, price did not sell off straight away. Price carried on going higher and higher and higher. So I mean, these are 1 hour candlesticks. So as soon as the first touch happened, price carried on going for 1, 2, 3, 4, 5, 6, 7 hours straight up, and then it started coming down. So how would you know exactly when to start selling off? The answer is obviously, well, this is not my strategy. I never use Bollinger Bands, but this is exactly why I moved away from Bollinger Bands. I would never use them again. Just me personally. That's me personally. Other traders do. Some traders do use them. Another one. Okay, so as soon as price. Okay, this one here, price did touch this one and bounced off. But if I turn on the, let's see, what session would this be? Asian session. I don't trade in Asian session. So by example, Asian session, this would be 3 a.m. in the morning. I'd be asleep then. I'm from the UK, so 3 a.m. here, obviously I would be asleep. So if I just turned off to make it a bit more clear, so I would not trade at that period, so that wouldn't work for me. And then again, okay, the next, price touches the bottom again, and from the example as the presentation I was giving earlier, price touches this line and it's supposed to shoot back up. But what it does is after 2 hours, the next 2 hours, price is just falling and falling. So 2, 3, 4, and then it comes back up here. So this is why, I mean, by the time you get from this journey to this journey, you lost a few trades, unless you have a bigger stop loss. So let's just say, okay, someone might say, well, I can place the trade here, have a stop loss this big, and I'll get a 1, 2, 4, but it's okay, might even work down here. But I mean, okay, the touch happened here, but then look, you enter the trade here, but then look, you're gonna get stopped out. It's not gonna work. I mean, you might find ways to make it work. Okay, first touch here, but then how do you know if the price is gonna stop there or is it gonna stop here? Like, look at the wick, even if you, okay, first touch was here, right? So okay, you get a 1 to 4 there. So I mean, this strategy, I would not use it. It's not, I mean, I've not even looked at the sessions yet. Let's see what times are these. Okay, so that's London session, right? Price falls down here, touches the blue line, comes back up. This is Asian session. That's a loss. Asian session, I wouldn't trade at that time. So for me personally, this strategy, I would not use this. I use a 1 to 10 strategy. It works perfectly, for my trading style. I wouldn't use it, like I said, but you can have a play around with it. It might suit, but yeah, I wouldn't use this. I mean, I just think it just makes a big mess of my charts. So if I just get rid of this, there's another indicator, the RSI, relative strength index. Okay, so 70-30, right? So now if we look at, if I don't know if the mouse is showing or not. So for example's sake, I'm just gonna draw this line here. So if you look at it now, if you look at the candlestick, it's in a sell, the price is selling off. And if you look at the same line right at the bottom where the RSI is, it's touching the 30% at the bottom area, and it just touches and bounces off. And as shown on the London session on the Thursday 30th November, price bounces and just bounces off. So okay, that would have been, but then again, where would you enter from? Would you enter straight away? There's going to be different confluences. You can't just go on the basis of that. Now this is a very basic strategy, only with the like 1 or 2 confluences, not even that. Again, I don't use these indicators. I've tried them, they're lagging indicators. You'll only know once you try, what I'm talking about. So if I just get rid of this, I mean, you can have a play around with it. Some traders do use them, some traders don't. I'm one of them traders that don't use them. So you won't know until you don't try, right? So this was just a quick introduction to some basic indicators and 1 or 2 little strategies at the end. Not the best strategies, obviously, just keeping it nice and simple for you guys. And yeah, I hope that was helpful and provide some value in any way. So like and subscribe if you haven't already, guys. I'm out.